Good afternoon. This is Stock Watch with Chris Pedersen on Wednesday, the 13th of September, 2023. Any advice provided is general advice and may not be suitable for you. Always consult an advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. A few observations I've made. Conventional wisdom has said we're going to have a recession. It's been for the past 2 years. We haven't had it. Think about it. Iron ore would decline. Well, they've been talking about it declining for the past 3 years. However, today, it's at $120 per ton, stronger than ever. Interest rates would rise again. Well, we don't see that happening. ASX, past few months has been very flat through the earnings season. However, what is very important here is individual component stocks and sectors have been anything but flat. I included this slide today because I wanted to have you look at where true growth is around the world. You'll see that Australia is outperforming most markets. Thus, investing in equities in Australia is a winner. ASX100, this is the earnings season, the top 7 winners it's worth looking at, and the ASX100, the top 7 losers. Obviously, you avoid losers by winners. AMP, Woodside, and GUD. Well, we had viewers write in and make a request, so today I'm going to cover these 3 companies. If you want to make any suggestions, send an email. First off the rank here is AMP Limited. Well, AMP's basically been a dog for quite some time, but it's now trading at $1.28. If you take a look at the chart, this is a 1-year chart, it started rallying before the earnings announcement. It still has some upside, and I'll go into the fundamentals. Market cap is $3.6 billion. I have a 12-month price target of $1.35. Personally, this is a little higher than most brokers. Brokers tend to be a little slow in coming around. The revenue growth rate for each of the next 2 years is around 10% per annum. This is very attractive. The earnings per share growth is also very attractive at 19%. And dividend growth is estimated at 18%. However, bear in mind, this is off a very low base. The PE on next year's earnings per share estimate of 9 cents is only 14.2 times, and the yield for next year's dividend estimate of 7 cents is over 5%. The free cash flow is what worries me most about AMP. It's around negative 30%. Their payout ratio, well, it's attractive. It's not at 100%. So it does have potential to increase dividends if they get their free cash flow in order. My view on AMP is it has an excellent opportunity to grow if they integrate and use AMP Bank as more of their overall business. Other than that, AMP is getting their costs under control. Because of the negative free cash flow, I don't rate it a full buy per se, but I would buy 50% weighting on it. Woodside Energy, WDS. This is a company that just continues going from strength to strength. Long term, it has been a performer. It's trading right now $37.83. Look at the 3-year chart and you'll see what I mean. It just continues to grow. Looking at the fundamentals, it has a market cap of $72 billion. Most brokers are neutral on it. I have a 12-month price target of $38. This is a little bit higher than most brokers. Revenue growth rate for each of the next 2 years is only around 3% per annum, and the earnings per share growth is flat, and the dividend growth is around negative 4%. These are generally consensus numbers. The PE on next year's earnings per share of $1.49 is 24 times. This is a little bit on the high side. The yield on next year's dividend estimate of $1.28 is 3.4%. This is also attractive. Free cash flow is stellar. It's 6%. And they pay out 80% in dividend. Now, what is attractive with Woodside is it has a very strong balance sheet. And bottom line, cutting through all of this, if Warren Buffett likes oil and gas sector right now, well, I like it too, and Woodside is Australia's best company in this sector. I waited a buy with a half weight. GUD Holdings is the third company today. Code on the ASX is GUD. It's trading around $12.37. This company, well, it was stagnating for some time and then it fell off, as you can see from the chart, due to COVID, but now it's recovering. It's in the auto industry. It has a market cap of $1.7 billion. Many brokers rated a buy. It had an excellent earnings surprise in August. It is much better for companies to have positive earnings surprises than negative surprises. I have a 12-month price target of $13.50. The revenue growth rate for 2023 to 2025 is only 2% per annum, but that's not the whole story. The earnings per share growth is 7%, and what I really like here is its dividend growth rate for each of the next 2 years at 20% per annum. Dividend growth rate historically is what drives prices. The PE on the 2025 earnings estimate of 95 cents is only 13 times, while the yield for the 2025 dividend estimate of 56 cents is 4.5%. It has excellent free cash flow at 9%, and its payout is 55%, which means it has plenty of room for retained earnings and to increase payout to keep that dividend up, to keep the stock price moving upwards. Auto sales in Australia continue to grow, not quite as fast as during COVID, but GUD is well positioned to continue to grow and pass on cost inflation. This is significant. It has great cash flow, great dividend growth. I feel it's still a buy, even though it's moved up dramatically since its results. As always, if you want to learn more about anything I covered today, send an email request to stockwatch@fnn.com.au and direct it to me, Chris Pedersen. Have a great afternoon. Thank you.